There's an old adage that says never fight the Fed. Well, we got a Goldilocks report on Friday for jobs. We had less than expected jobs and we had lower than expected hourly wage growth, but we still added a strong amount of jobs. So that's a Goldilocks report, in my opinion. And the pre market proved that by not selling off the stock market. The stock market actually rallied a bit off of that jobs number in the news. So, what do we have? We have a Goldilocks report, and we have a Fed now that's changing its tone from saying that they are still focused on getting inflation down at all costs, but not at the expense of hurting the economy, which was not their stance a year ago. They were saying a year ago, we're focused on getting inflation down no matter what. Hey, if something has to break, something has to break. I mean, we don't want it to, but hey, so be it. Now they're saying we don't really want to cause any type of major slowdown. So to me, that's a Fed that's trying to work in our favor. We also know that they only want to raise by 25 basis points, and we've already raised from 0 to 4-ish, almost 5. And so when we get to 5, then they're done. And now the big argument is, do they get to 5% terminal rate or 6% terminal rate? That's the big argument now. And I've just got to say, even if we go to 6, it's not a big deal. We've lived with 4 to 5% interest rates before in a bull market, and 6% historically is still low. So I think all of this is a buying opportunity. However, let's be serious and look at the granular data in front of us. So we also had the bank blow up on Friday, the Silicon Valley Bank. And that could make people think that, as we break this 200-day moving average on the SPY, that things could accelerate because we had a bank failure. Now something is breaking. Well, we had a lot of things break. A crypto crash. We had Credit Suisse come out in Europe and almost fail. We had Europe itself almost go in recession from high energy prices. We had a lot of things break. The Bank of England had issues with their pension plans. So many stocks blew up, individual stocks, not the indexes. So here we are, the S&P 500, and we broke the 200-day moving average, that orange line. And I was claiming that we could hug it and hug it and hug it. But if we did break it, even if we broke it, we could hug it. But even if we didn't hug it, like we attempted to do a few times, the 380 would be the next stop of support. So 380, December 2023, that was 380, that basing pattern. And we're coming back to there. So has anything really changed? Has the Fed become more hawkish? I don't think so. I think they're becoming more data dependent. And if anything, the Silicon Valley Bank gave the Fed the excuse they needed to perhaps lower rates even further. So, maybe just go with a 25 basis point hike next month. So that would be good. That's what we've already been expecting, 25 basis points. People are like, well, but the Fed keeps raising rates. I know, but we've been expecting that. In 2022, we priced that in. We know that they did the bulk of the raising early on, and now they're just doing the last little bits at the end, 0.25, 0.25, and then there will even be a rate cut factored in by the end of the year, perhaps. And next year, they're going to continue to hold rates higher as they projected in 2024, but in 2025, the rates are supposed to come down below 3%, the Fed funds rate, as I've put on prior videos. So if it's going to be below 3% in 2025, then that means 2024 must be a year of cutting. And you could factor in one more cut in 2023. You could. We might not get that as the economy, stays strong. And we don't cut, but we just go 25 basis points. There are a multitude of ways that the Fed can be gentle on us. And as long as the economy is growing, which it is, GDP is growing, and as long as jobs are strong, which jobs are very strong, then the economy should remain strong because the economy is 70% consumer driven. So if everyone has a job, then they're consuming and then they're growing GDP. So it keeps us out of a recession when you have high jobs. So I thought the number was Goldilocks because we lost some jobs, but our employment rate is still high, and people need to earn more in their wages because inflation is so bad. So, you want them to earn higher wages. You don't want them to see that going down. So these are all good things, and can we withstand it? And then the question is, everyone else's mind is, well, is it too good, and it's going to force the Fed to raise rates by 50 basis points? Again, even if they did that, they're just going to go to 6 perhaps. One guy is saying 7, but I think he's just trying to talk us into a bracketed range where we can kind of price and game the market accordingly between 5% and 7%, 7 being high, 5 being low, 6 is in the middle where everyone's trying to make it. But I think we're going to come somewhere in between 5 and 6. I'm not an economist. I'm not trying to predict anything. I'm just saying that it's in the Fed's best interest to keep unemployment low and to keep inflation low. And when you do those two things, it creates a strong economy. So we got through with what the Fed is trying to say. They're trying to be more data dependent. They're trying to engineer a soft landing. They don't want to raise rates at the expense of a recession. We talked about the jobs number, how it was a Goldilocks number in my opinion. Yes, still strong, but you want strength. You want a strong economy. Come on, guys. You just want also things that you can give the Fed for a win, like slowing wage growth and slowing jobs growth. So we got both of those things, albeit everything is still strong. It is slowing. And then we have this 200-day moving average, which is, the fly in the ointment. Why is this breaking when we got a Goldilocks report? Well, again, you had the Silicon Valley Bank debacle on Friday, which I won't get into, but just everyone tweeted their friends and texted their tech buddies, and they all decided to pull their funds from this company at one time, causing a massive run on the bank. So we have the 200-day break here, and I believe it was exacerbated by the Silicon Valley Bank going insolvent. So is this going to be another 08? Is this another Lehman? I don't think so, because it was a tech-oriented bank that lended to startups. Now, I know a lot of companies had their assets with the bank, kind of like a Roku had a certain amount of their assets with that bank. But let's just say that this weekend the bank finds a buyer, which could very realistically happen. If they found a buyer and all the deposits were secured, you could see a massive rally in tech stocks. One more leg down, we'll be at 380, and we'll be touching the gray, which is deeply oversold territory. We'll be back in October lows, which was, the Ukraine war and all these other kinds of things that were happening in 2022. Are things really as bad as that? We've already done the bulk of the raising. S&P 500 companies' earnings are in, and they're doing pretty well. The economy is still growing because we have strong jobs, as I alluded to before. So I think that there's not much room to go before a bottom here. Also, look at the VIX. Remember in our last video, a few videos back, signs of a market bottom. So we said when the VIX hits 30s, that's when you want to look at buying the market. Well, look, we got up to about 30 here. So a big spike on the VIX. So we got to 30. We're almost overbought now on the VIX. See the gray area up top, almost near 80. We're nearly overbought. So the VIX is a measure of fear buying, because it measures all the put buying, all the options and puts when people are scared. And obviously people got really scared on Friday, and I think it's because of the Silicon Valley Bank issue, and it definitely wasn't from the jobs number, because again, the pre-market, we were up in the pre-market on that jobs announcement. So I think it was the Silicon Valley Bank developments, and you could easily see this spike top out. You could have one more day of pain. It looks like to 30, we reached in the 30s, and that would coincide with 380 on the S&P, as I showed you before. So we get one more spike of the VIX into the 30s territory. It will be overbought, and then that will move the market down to the 380 territory, and then it will be oversold. So these are the makings of a short-term bottom, at least. And then when you think long-term, what would be the issue that derails the S&P from keeping its uptrend intact? Which on a max chart, you can see it has this uptrend intact. What would derail this on a long-term basis? I mean, obviously you see here that 300 could be a spot where we fall to. That would be a nice support area, and then we could bounce around there. But that would be the 2020 highs, And a lot of people are calling for that on the street, like in Reddit and in just your local neighborhood near you. But on CNBC, you're hearing a lot of pros call for 3,800 and 3,600. 3,000 is just a stretch. So 300 on the SPY is a stretch. And look, we've already tagged 40 on the SPY. And when you look at a long-term historical chart of SPY, 40 is that area. Besides the dot-com bubble and besides the '08 crash, which were both unprecedented times, we're at 40. We tagged 40 again. So if we were to go, to 300 on SPY from some huge break here, we would be near 20 again, just like in the worst times in history, .com and '08. And that's just not what we're having right now. We have strong earnings right now. The banks are very well capitalized. They have twice the amount of of cushion as before in the '08 crash. They have less leverage. They have more responsible practices with their lending. The banks shouldn't be failing like in '08, so we shouldn't see a huge drop below 380 on the S&P, in my opinion. We should hold 380, because if we were holding 380 last year when the worst was thrown at us, Ukraine, high inflation, recession fears, then why would this time be the final straw that broke the camel's back? Why would this point in the year, after we waited a whole year in the bear market, why would now be the time everything is going to drop? And why would all the community of Reddit followers and YouTube and every social media outlet you can think of, they're all bearish? And how can they all be right? When everyone's saying one thing, including grandma and the taxi cab driver, they're giving you stock tips. That's when you go opposite them. That's the rule of thumb. You go opposite the crowd, and the whole crowd is bearish right now. And maybe they're right, and it's a phenomenon in time where they're right because the internet and 5G and everyone's wavelengths are synced up together, and they can now, even without a finance degree or any market experience, they can call market tops and bottoms. Maybe that's happening, but I really doubt it. Okay, I'm not going to go completely hedged on it yet because I'm still bullish. But if the proverbial what hits the fan, then I will definitely be selling more Cornerstone short, because it pays me. It lowers my margin to do it, and I don't have to pay the dividend if I do it after the X date of the 14th. Go look that up. We just did a video on Carl Icahn, IEP. They had their X date on the 10th. Very important that you got in before the 10th so you could get the dividend. Well, on Cornerstone, their X date is on the 14th. So it's very important that you get in before the 14th to get the dividend. And it's also important that you remove your shorts before the 14th so you don't have to pay that dividend. So the last thing I want to say is we're going to move into our next tiers of exit strategy. So we have 1 star here for emergency Monday. We're going to do this anyway. We're going to buy DPST shorts, buy high best shorts, and we're going to close all stock puts. Then we're going to sell half of EDF, FCO. EDF, we were up 50% on it, if you remember. Now we're only up 23% in EDF, but we were up 50% in it. And FCO is also a play that we're up on, $800, 16%. What these are emerging market plays, and they're kind of risky. So if the market's going to take a leg lower, these are going to be the ones that are most sensitive. So I want to sell half of EDF. I don't want to lose that income. And I want to sell a majority of FCO. Okay. I also want to dump my glows. So this is the 2nd star. Sell half of EDF, 3/4 of FCO. That'll raise 10K and drop our margin by 10K. And then if we really get bad, I want to dump my glows, which have already been on the chopping block, glow 2 and 2. These funds are Cloth global funds. They used to be really good funds, but they have leverage and they got hurt in 2022. People don't know if they're going to make it back. They had to cut their dividends. I want to dump glows as well as some of these triple longs that I have, like UPRO and TQQ, because they don't pay me much in dividends, in the form of dividends. And so my plan will just be to dump the glows, dump the triple longs, dump all stocks too. All these stocks in here, Citigroup, Altria, Mo. I love all these stocks. SLG, Devon, Rio, they provide me valuable sector exposure. Rio with metals, Devon with energies, SLG with real estate, Citigroup financials, Mo consumer non-cyclical, I reduced THW on Friday to 2,000. I'll knock that down. That's our healthcare play. These are where our dividends are not really a big contributor to our yearly gains, our monthly earnings. So I don't mind selling these because I won't lose much income in the process. So we'll dump the glows, we'll dump EDF. Well, first we'll dump EDF, FCO. Then we'll dump the glows and our stocks, as well as our triples, UPRO and TQQ. And you might say, well, why'd you buy them? Well, we have sold puts in UPRO and TQQ. And so that's the plan, is to dump these, and then and that'll raise 20K. So 10K from selling half EDF and 10K from selling 3/4 FCO. That's 10K total. Then we'll dump the glows, dump triple stocks, dump the stocks, and that's another 20K out that we're going to raise in margin. So we would be 30K total, 10K plus 20K. So our margin would go from 230 to 200 if we did that. And then in the emergency phase, if the market's really tanking, then we're going to sell short more Cornerstone. We're going to sell all of our other funds that you see in there, all of our favorite funds, GOF, RIV, IEP, USA. I sell them all. I love them, but I have no attachment to them. I just want to, I buy the same amount back in the triple C's. See, if Cornerstone has a 20% dividend and the others have 10% dividends, well, if I had 100K in the 10%, I can drop 50K in the Cornerstone 20% and get the same yield back. So I can dump all these funds and I will not lose any of my estimated income as long as I buy back half the amount in Cornerstone. And do I feel comfortable putting all my money in one thing? No. But if I was going to put all my money in one thing, it would be the Cornerstone, the C's, because they are 4-star Morningstar and they beat everything else in the past. They beat Schwab D, they beat SPY. Go see our past videos on that. And then we get assigned in our triple long. So we would love for these assignments to come in. UPRO, TQQ, because as you saw in our last video, $10,000 invested in each of those, TQQ and UPRO made you $1 million in 10 years. So we want these funds, but we don't necessarily want to own them while the market's crashing. We'll sell them. We'll get rid of UPRO, TQQ. We'll dump that, and we'll just wait for our assignment and the sold puts. And if we just go higher from here, well, then great. All of our longs are situated. We're heavily invested. We're ready to capitalize if we move higher, but this is the plan if we go lower, and still be stronger for when the bull market returns. Thank you.